Okay, so we're going to start with the keynote presentation of Professor Olivia Mitchell and Professor Luis Viseira, and then we're going to have a 5-minute break. So Professor Olivia Mitchell is the International Foundation and Employee Benefit Plans Professor, as well as Professor of Insurance, Risk Management and Business Economic Policy at the Wharton School of the University of Pennsylvania. She has a very broad research agenda and interest that span public and private pensions, insurance and risk management, financial literacy, and public finance. Her research has always been really permeated by the incredible attention to policy issues, and indeed she has testified before numerous committees at the US Congress and the UK and Australian parliaments. So it's really my pleasure to give you the floor. And she will talk about rebuilding retirement system post-COVID-19. Please, Olivia.
Thank you very much, Anders Andersson and Paolo Sodini, and of course, the Swedish House of Finance for this cordial invitation. With your permission, I would like to share my screen and start my discussion. So thank you very much again, and it's my pleasure to talk about some of my ideas and hopes for rebuilding retirement systems post-COVID. I was hoping that we would be closer to the post-COVID phase today, but I guess at least in the US, we're still in the middle of it. But just to give you a little bit of background, in many countries, we have the proverbial three-legged stool of retirement security. That is public social security, employer-sponsored pensions, and private savings. And each of the legs of the three-legged stool could be longer or shorter, but they're present in most countries. Now, of course, when it comes to pensions, some of the audience is already a pension guru designation. Some of the audience may be less familiar with pensions, but there are two primary types: defined benefit, where it is what it sounds like. The benefit formula is what's promised. So for example, they might give you 2% times your final pay times your years of service. If you'd worked there for 30 years, 30 times 2 is 60, so you get 60% of your final pay as an annuity, a payment until you die. The alternative primary structure is defined contribution plans, which you're very familiar with in Sweden, I know, and typically there what's specified is the contribution amount as a percent of your pay. And these are very common in the Americas, especially in the US with 401k plans. And there are hybrid plans, which we can talk about if you're interested during the Q&A period. One of the big questions I get asked a lot is, why should you ever fund a pension promise? And there are pros and cons. Having assets ring-fenced set aside to back the pension promise can reduce uncertainty about future contributions. It can also provide the opportunity to diversify your portfolio. It can allow workers to move from company to company because their pension asset pool can be portable. And many developing countries have argued that it could deepen capital market and enhance growth. On the negative side, it does require one group at least to pay twice if you're moving from a pay-as-you-go system and into a funded any kind of funded pension system. Why? Because the retirees need to be supported, and the groups starting the funded system need to save for themselves as well. Some people have argued that funded plans are more costly to operate. I think that's dubious. And then obviously you need to have supervision and regulation of the funds to make sure they're handled well. Here are two simple pictures that I think really illustrate the way I look at pensions. This is a pay-as-you-go system where operating income, i.e. contributions, come in and the benefits get paid directly to pensioners. This is the funded plan, quite a bit more complicated. You have contributions from employers going in, you have employee contributions on the left, you have investment earnings, and those all mingle together in the pension fund such that the money is available to be paid to pensioners at the appropriate time. There's one other little faucet here, which I haven't mentioned yet, but basically that's fees and costs and commissions. It can be a small pipe or it can be a big pipe, and that takes attention, of course. Now, in terms of the types of plans around the world, we have across the top, does the plan offer individual accounts? No or yes. And down the left-hand side, is the plan funded? No or yes. And there are entries in all of these boxes. So the US, most of the European countries have unfunded plans. They're pay-as-you-go, and they're not individual accounts. Corporate defined benefit plans in Germany are another example of that. In the bottom right-hand corner, we have individual accounts and funded accounts, such as 401k plans, Chile's AFP plan, Australia, Sweden, etc. Bottom left, we have plans which are funded, but they're not individual accounts. And these typically come from the British legacy of provident funds in Singapore and Malaysia, where there's an asset pool invested by some central unit, but they're not held as individual accounts. US corporate and public DB plans are like that too. And finally, notional accounts. And many countries, and I believe it's still true of Sweden, have a point system where it's not necessarily fully funded, but they are individual accounts. So there's records kept of how much you've contributed. Now, full funding is a complicated issue, but not so much in the defined contribution realm. So full funding in the DC area simply means the assets on hand in the plan are equal to the liabilities of the plan. As long as the plan sponsor has contributed and invested the money, the assets are the liabilities. Much more complicated in defined benefit land, the assets there are equal to the expected present value of the promised benefits in a full funding case. However, if too little contributions have been put in or the investment performance has been bad, the assets can be quite a bit below the promised liabilities. And obviously, reporting and accounting rules play a very big role. Now, with that snapshot of what pension land looks like, we have to acknowledge that prior to COVID-19, retirement systems around the world were not healthy. Social security systems in the US prominently, and many other countries were facing insolvency. Many private and public defined benefit plans faced enormous underfunding, on top of which the low returns that we've experienced during the last decade have hurt DC plans tremendously. And so the World Economic Forum actually in 2015 deemed underfunded pensions a global time bomb, especially in China, India, UK, and the US. The size of the retirement gap pre-COVID was estimated using this set of bar charts. So the black bars refer to how many years of assets retirees have to live on after retirement on average, 8.3 in the US. The blue bars refer to what the life expectancy is for the population at retirement, 10.9. So already we had a gap between what people had on hand and what they were likely to need. And that gap obviously was the most prominent in Japan, where longevity is still the highest. Again, at the dawn, right before the COVID pandemic broke out, Melbourne Mercer pension sustainability rankings came out. And you have here those that received a grade of A, Netherlands and Denmark, seen as very, very strong. Australia and Sweden in the next group, sound with some areas for improvement. And then as you go down the list, you see the US not in very good shape, and then many developing countries having very fragile pension plans. And then at the bottom, receiving a grade of D was these countries you can see, Japan especially, but also India, some of the most populous countries in the world, Philippines, and so forth. Moreover, and this is not a talk about healthcare costs in retirement, but it's important to mention, preparedness for healthcare costs in retirement were also all over the place. Sweden doing pretty well, up at the 70 percentile in the Global Health Security Index score. Ironically, the US was seen as pretty well prepared. though we've faltered quite substantially. So we have to remember that healthcare costs are a big part of retirement as well. So what about the impact of COVID-19? The latest International Monetary Fund projections indicate that the US GDP will fall by 8% this year, Euro area maybe by 10%, Russia by 6%, and developing nations, sorry, even more. So the forecasts are a bit more positive for next year, but we shall see. The result of all this and the result of low returns is that it's going to become much more expensive to generate retirement payouts. This is a chart that indicated in the dark bars how much money you would need to save, say in 2005, to generate 1 year of retirement payments for the next 25 years. And in 2005, it was only less than $10. In March of 2020, after the COVID impact hit, you can see that there was an increase in the amount needed to be saved, and certainly quite a bit higher than before the impact. Of course, countries have rolled out very rapid responses, some more than others, and governments have responded. This was taken June 6th. There is an update. I provide the URL since ILO won't let me copy paste anymore. But you see the darker colors represent countries with strong social protection responses and the lighter countries with weaker social protection responses. What kinds of responses did we see? Well, interestingly, they tended to be jobs protection, income protection, some health, but pensions are pretty far down the list. And that suggests that pension programs suffering during COVID-19 are still not well. Now, over time before COVID, there had been some increase in the possibility of people working from home, working self-employed, especially in the UK and France. Other countries, the US, Japan, not so much. And this is important because as the future unfolds, people are going to need to continue to work from home. And some people can. Travel agents, of course, don't have as much business as they used to have, but many others can. Others down at the bottom are probably less likely to be able to work from home. This is also influenced by the nature of public transportation. This top bar refers to the Newark, Jersey City, Pennsylvania commuting zone. The light blue bar suggests that this is the number of people, 20% using subway. The dark bar is other public transportation. And the problem is, in a pandemic, people can't safely commute to work in cities where they rely heavily on public transportation. And so this is still a problem. Job benefits have been compared across the world in terms of what has been available to people in this pandemic. Unfortunately, red is the least generous, and the US is very much in that camp. And Sweden looks quite a bit better in terms of unemployment benefits, not so great for some reason in maternity related entitlements, but other types of annual leave, sick pay, and so forth. These benefits are part of the safety net, making it possible for the economy to recover. Don't forget also that in times of low returns, we're all going to have to save a lot more. So for example, if the real return was estimated to be 3% and you started saving 40 years before retirement, you would only have to save about 11% of your payroll in order to reach a replacement rate, which was equal to half your pre-retirement salary. The notion being that Social Security benefits and perhaps reduced expenses in retirement would take care of the rest. If you waited till you were 45 and you were planning on retiring at 65, then you'd have to save over a quarter of your salary, which is obviously quite painful. But those were in the good old days. The new days where returns are 1% or even 0, as we've seen throughout much of Europe, If you started saving 40 years before retirement, you'd have to still save about a quarter of your salary. And heaven help you if you didn't bother to save until 20 years before retirement. You'd have to save half of your paycheck. So this is one of the realities we're going to have to be facing looking ahead. Now, some people have said to me, well, you know, COVID is taking care of all the old people. They're not going to make it to retirement. That's not true, at least from what we know to date. The world centenarian population is continuing to grow. And even though the older population has been somewhat more susceptible to COVID, there's still a lot of people reaching old age. So the result is retirement ages absolutely must rise. Here we have the fraction of the people who are retiring or working until age 70. That's what this red bar represents. The panel on the left is men, the panel on the right is women. In the US, still, most American men retire around 65 and American women around the same age. And you see much lower retirement age. Unfortunately, I couldn't get Sweden in this graph, but much lower retirement ages in much of the European area. And so simply, it's going to be much less possible to save enough to be able to live much longer. And one of the results is going to have to be later retirement. Of course, there's been research that suggested many people have a substantial capacity to work. So this was from an NBER report, which analyzed the ability of people to, men in this case, the ability of people to work longer. The estimate was in the UK, they could work over 8 years longer, given their their physical capacity at this point. Somewhat less in Sweden, but the point is there's still more opportunities to work longer. Now, post-COVID, or during COVID, I should say, the evidence suggests that there's going to be a big increase, millions of people increasing in extreme poverty, earning less than $1.90 a day. And the percentage increase is indicated at the top of the bars. These are three different scenarios, with a labor productivity scenario growing a little bit, total factor productivity, and trade costs really becoming expensive. And the punchline is really that the rural population is going to be in much worse shape, especially in Africa, south of Sahara, and in Southeast Asia. So even though many of us focus on what's going on in developed countries, I think we have to realize that the economic consequences around the world are going to be long and lingering and severe. So just in conclusion, and then I want to have some questions, we want to be able to better manage retirement risk with the retirement systems of the future. I think we have to start by reinventing what we mean by retirement. Back in the early 1900s, people didn't retire. They worked their whole lives, and when they could no longer plow the field, they would go tend the chickens, or they'd take care of the grandchildren. We have to build human capital so that we can work longer and our skills are demanded at older ages. I'm not going to talk much about financial literacy because Ana Maria, my frequent co-author, is going to speak on that, but that's obviously a building block of a future retirement system. We're going to have to save a lot more, invest smarter, and diversify better. People are still, in many countries, putting all their money into one house, and that simply is not consistent with good diversification. We have to insure against longevity risk. It is true that as we're living longer, it's also the case that there's more uncertainty about how we're going to live. And so annuities should play a very big role. Home equity should become better accessible. Again, around the world, most older people have a home, they have some home equity. So reverse mortgages should play a big role in remaking retirement. And of course, we're going to have to restructure public and private pensions. I don't underestimate the political challenge that this requires, but pensions are going to have to start telling people, work until you're 80. So the three questions that I think are really at the heart of this is, number one, who should manage the risks facing the elderly? In the old days, it was individuals and families. Then the responsibility passed to employers and the government. But increasingly, none of those entities want to bear the full burden of taking care of the elderly. Funded versus pay as you go, that's a continuing tension, and pension versus healthcare. But ultimately, the big question is how much of GDP should go to the elderly and who should pay for it? And how do we get to the political consensus around these three difficult issues? Before stopping, I just wanted to mention in passing that this year we have just started a new International Pension Research Association, IPRA, and that's the website. This is supported by the OECD, and every year we have an annual meeting. This year was virtual, of course, but our hope is to be the global voice of research in the fields of pensions, aging, and retirement. So if you're interested, take a look and join us as we try to improve the quality and the impact of research on pensions and related issues. So with that, I thank you very much and refer you to my website where we have lots of free books and working papers, which you can download if you can't sleep tonight. Thanks.
Perfect. Thank you so much, Olivia. Let me kind of follow up with a couple of questions. The first one, I think it's an important topic when it comes to COVID-19 and other type of another crisis. In many countries, you can withdraw pension before you actually retire, or at least you can borrow against your DC contributions, against your DC wealth. That's not the case, if I'm not wrong, in Sweden. But that would actually, in a crisis situation, would allow people to, you know, kind of access some liquidity that otherwise it would be difficult to obtain. So how do you think about this issue? Is it something we should allow? What are the pros and cons? Maybe it's a problem outside. Maybe we should allow it only during crisis time because other people like kind of, you know, overdo it otherwise.
Very good question, and a very difficult one, obviously, during this time of financial stringency and unemployment and so forth. Some countries have allowed it. The US has allowed people to borrow against their 401ks. As long as they remain employed, then they pay back through their paycheck each month. The problem arises if you lose your job, then you either have to pay back 100% of the loan, or you get taxed on it, plus you pay a 50% penalty for early withdrawal. So that can be extremely punitive, and many people that borrow don't really realize that that might be hanging over them. Now, since the onset of COVID, the US Congress has allowed people to actually cash out some of their pension. They do have to pay income tax on it, but the penalty is removed for at least this year. The big problem, of course, is that you are robbing today, you're robbing your future to cover today. Are there better policies? Yes, I think so. One of them has been followed in various European countries that have offered wage subsidy programs, such that the government helps subsidize people to stay related to their employer, to continue working, maybe even part-time. So that's a way to transfer money to people needing it today without killing the pension possibilities in the future. Another point I would make is I've worked quite a bit in Chile and in Latin America, and Chile has a 10% contribution mandate. 10% of your pay must be contributed every year when you're working. Now, up until now, Chile has not permitted any early withdrawal, but there have been so many protests and there have been such terrible economic circumstances that Congress finally permitted people to withdraw 10% of their assets, or if your assets were below something like $10,000, you could take it all. And now people are saying, well, if you let me take 10, why can't I take all of it? In other words, the nose of the camel has gone under the tent, and people say, why stop at 10? And why stop at a pandemic? After all, if my daughter's getting married and I need money to pay for her wedding, I should be able, that's a hardship too. So it's a slippery slope. And I'm very discouraged by the number of countries, Australia has also permitted this, that have allowed people to start rating their pensions.
You talked about, you know, kind of various way forward, if you want. I'm a little bit curious about these hybrid plans of DB and DC together. I mean, if you can kind of elaborate on that quickly, if there is something that actually could be, you know, could be gained by having, you know, system that consider both. Maybe, you know, there is a way to fund them differently during crisis, or I don't know.
Various countries have, and in fact, various other entities, companies have put together hybrid plans. Some of them are explicit. So there's a DC plan, and then underneath there's a DB plan. The defined benefit plan is only intended to pay a fairly low flat benefit. And when it gets overfunded, if it ever does, then the extra contributions could go into the DC plan. And conversely, when the defined benefit plan is underfunded, then the DC assets can be moved back and forth. So that would be an explicit two-tier system. Other plans like the defined ambition plan in the Netherlands has an element of both, where they try to hit a target, but if the assets are insufficient, then benefits have to be cut. And that has occurred during the pandemic, and it's typically not very popular to cut benefits around the world. In Japan, they've had a system where they call it a macroeconomic slide, which is kind of a curious name. But anyway, so if the funding of the pension goes up, then benefits can rise. If the funding declines, benefits are supposed to be cut. The first time that the benefits should have been cut, it was too politically impossible to do. So the reality is, ex ante, it might sound very interesting. Ex post, the politicians have trouble.